Hello, folks. It is my great pleasure to have on a good friend, somebody who did a fabulous job explaining crude oil this week on the halftime report. That person is Mark Fisher, an energy trader and metals trader. Actually began as a metals trader, didn't you, Mark?
That's correct. That's correct. Way back in the days.
Fabulous stories there, folks. Definitely need to get Mark on for some of those Hunt Brothers stories and so forth. But this week, because of what just happened in crude oil, we thought who better to have on to talk a little bit about the craziness of this market in WTI as well as natural gas, because I think Mark's got some insights into natural gas that are pretty, well, I'll just say that I think there are some potential moves in natural gas coming based on the movements that Mark has described. So with that, I'm going to toss it back over to you, Mark. And what the heck was going on with crude oil from Monday night all the way until it stopped, the May contract stopped trading and went to settlement? Can you explain that to us?
Well, the May contract really stopped trading Tuesday, and the craziness day was Monday. And basically what happened is that the exchange had warned everybody that the market could go negative. No one really took it seriously. No one took anything. No one had built into their models the possibility of negative strike prices and negative prices at all. And you could see that on Monday, the marketplace was looking to sell May futures all day. No one knew, again, you could see the general direction, but no one knew how far it was going to go. And obviously, because there was no storage at all left that was for lease, for sale, and Cushing, all these barrels backed up. And you had people that were going to take delivery that didn't have any place to put the delivery, that were forced to sell contracts. You had a fund out of China that basically, for some reason, was rolling May futures contracts on the last day, that they could, and they got screwed. And basically what ended up happening is most of the volume in May futures traded when May was positive on the day. But once May went negative, it was complete chaos because of, one, negative pricing, two, because not all machines could show negative pricing. Like if you were on certain platforms, you couldn't even see negative pricing. And then on top of that, there wasn't many contracts relative to the size of the volume that traded negative, but the price movement was so large with the circuit breakers and everything else that the market ended up selling at negative like almost $38. So basically, if you were short one May contract, which had sold at like, I don't know, $16, and basically put up a margin of, I don't know, $7,000, $8,000, you had made, open to close, $53,000 on one contract.
Wow. Just on that move, on one contract.
Right. And what I was talking to John before about is that natural gas had some funky price behavior on Friday afternoon. And it's going to be interesting to see how natural gas opens for business Sunday night, because again, natural gas expires on Tuesday, option expiration is on Monday, and with LNG exports being turned away, and with the price action in May late Friday, which I don't think a lot of people paid attention to, I think that, do I think natural gas is going negative? No. Do I think May futures may have a bit of an issue and trading at a discount to June? Probably. So we'll see Sunday night into Monday, but the fear of what just happened will be in the back of everyone's psychological mind frame, which may even exaggerate the move even more. I could be wrong, but we'll see.
Right, because as you say, Mark, normal tick, the normal bids and offers in natural gas, it trades in a what? In a 1-2 tick range?
Yeah, natural gas, physical natural gas futures to cash natural gas futures usually trade 1 tick, 2 ticks, maybe 5, 7 ticks. And most of the time, it's futures premium. And on Friday's close, it was trading futures negative, like 24 ticks, which is kind of never been seen before for a while.
Wow.
And to your point before about silver, I just want to bring up to yourself and your viewers, maybe I'll tell you a funny story and today's comparison, if you want me to, John. It's up to you.
Sure, love to hear it.
So back in the silver days, back in the 70s and 80s, there used to be a broker who, I don't know if I should name his name, but I will anyway. His name was Norton Waltuck. And Norton's an old man now. Norton used to have tremendous influence in the silver market. And he would walk into the silver pit and just buy everything. It got to the point that was so crazy that people used to go be on the lookout for when Norton went into the building or when Norton went into the elevator, and people say Norton's in the elevator. And if you saw him get off, at the trading floor level, which was 7, okay, people used to go ahead and buy futures contracts thinking that he was going to come into the pit and buy futures afterwards. And it became a self-fulfilling prophecy to some degree, and it was crazy. Today, because Goldman Sachs has been so spot on in terms of their views of crude oil, when these Goldman Sachs reports come out, and they come out to everyone at the same time, okay? But the people who react on these Goldman Sachs reports first, that are all distributed at the same time, there's no edge to anybody, they're all, come out. But I wonder if the machines that read these Goldman Sachs reports faster than the human does, how much of an edge they get because they become the Norton Waltuck of the commodities markets, So again,
Sure.
but I remember, seriously, I remember sitting there and watching people stand by the elevator, and when Norton Waltuck used to go ahead and sometimes get off the elevator, the market would rally. He'd walk in the pit, the market would rally even more. If he started buying, it'd be, whatever. It almost became crazy. And other times, he'd step his foot outside the elevator on the trading floor. The market would rally. He'd go back in the elevator, I don't know, to go get lunch, never go to the floor, and the market would crash. It was insane.
Oh,
that
yeah.
One guy could do that, but it used to happen.
Oh, I believe it. Mark, you brought up several points, one of which, at least a couple of which I guess I have to touch on. Number one, there are a lot of people who were riding that crude oil contract into the final days of trading. That's not usually a smart move, is it?
Unless you're a sophisticated trader who does not have to, who can get in and out, and is not tied that they have to do certain things. You'd be next to crazy to trade these things, unless you really are nimble and can get in, get out, and understand the dynamics of what's going on. That the number of people that were trading this that shouldn't have been trading it is astronomical.
Now, the other thing is that, as you say, people on certain platforms couldn't even see that it went to negative pricing, because when have they ever put a minus sign in front of that future before?
Exactly. And certain platforms, which I don't want to mention by name, didn't have the technical capability to list negative pricing. So that when it froze down to 0, they just kept flashing one tick, and couldn't even price you couldn't even see the real price.
That's something that you've got to be aware of, folks, when you are on a platform, especially so many of these platforms, Mark, really haven't been upgraded in decades. I mean, ever since Globex and basically access to futures markets electronically came around, I don't know of a lot of people that have really upgraded those platforms. They're probably still code from 15, 20 years ago.
To be fair, there are some that have been updated.
Sure.
But you're right. There are a lot of them that haven't been. And to your point also, like I said, back in 1987, when we were trading options or trading futures, right at the bottom, all clearing firms, because they were worried about the credit risk of their their customers and traders, didn't allow many traders to trade anymore in equity futures because they were afraid of a blow up. Same way on Tuesday, a lot of clearing firms that clear energy futures wouldn't allow their customers to trade front month energy unless you have millions of dollars in your account, because they were worried about a blow up. And whenever that psychology takes over, that's usually a temporary bottom, which it kind of was.
Yeah. Well,
on top of that, the USO contract, which everyone believed to be a retail contract, right? Mm-hmm. If you read the FT from this week, you get the fact that a lot of the people who traded USO in volume, okay, not the number of people, but the actual amount that was created. I mean, obviously, most of the traders who traded USO, if you did it by numbers of people, were retail traders. But most of the money was institutional. And what these institutional traders were doing is they were using USO not to get long, but to get short.
Mm-hmm. Yep.
So
selling.
basically, USO was creating new contracts, not because of the long pressure, but because of the short pressure. And eventually what happened is, because USO was so dominant in the front month, and they had so much exposure that if June futures had gone to zero, that the whole USO ETF would have broken up. They scrambled to roll themselves back. So instead of being just a June contract, now they're in, 25% or 20% in June. They're in July. I've seen they rolled to September, and they're trying to move further and further back on the curve so that they don't go ahead and run the risk of negative pricing.
Now, Mark, when somebody does, let's talk just for a sec. I know you only have a few minutes, but as far as settlement, so we go into that May contract, it's in the final 24, 48 hours. All of a sudden, it's getting down to crunch time. And at that crunch time, it went from the day before closing negative 37.63. Again, like Mark said, folks, almost negative $38 per futures contract, and every full value Merck futures contract is for 1,000 barrels of crude oil. So it went from negative, Mark, to positive that next day. Describe maybe for people who don't understand why that may have happened, because it had a similar swing the other way from negative 37 to positive 10 or 11, right?
Right. So again, that move completely I don't even have an explanation for that, other than the fact that maybe some of the storage operators weren't ready on Monday, thinking that anything that took place, that this negative prices could happen. And so it took them a little while to get themselves organized to be able to take more May futures off the board. And when they got themselves organized and realized that they could take more barrels, the market went from negative 37 to positive 8, 9, 10 that you said. But there was a long time, even on Friday, that the market was trading zero, and it wasn't trading negative 37 anymore, but 0 and -2 and -4. It was only, again, I don't know how many contracts traded on Friday, but I'm sure it was a very small percentage of what I traded on Tuesday was a very small percentage of what it traded on Monday when it traded down to negative 37.
Well, and to your point, Mark, I think you told me that approximately under 5,000 contracts traded in negative pricing. Is that right?
I think so, but one of my traders says that I was wrong, and that was more, a lot more. But in any way, it was no more than 15% of the entire day's volume traded negative.
Crazy. And that contract, folks, was down to about 100,000 open interest, I think, right, Mark?
Yes.
Open
And
contracts.
Again, at 12 o'clock in the afternoon, May futures were trading $10. And so it basically went, dropped $50 in value in 2.5 hours of trading.
Crazy. All right. So now, as far as storage, so somebody says, well, I'm a big boy or big girl. I can take that. I can take it at settlement. Tell people what they have to be able to do and where they have to do it at Cushing, Oklahoma, right?
There's no chance that anybody that in your audience can take it. Okay?
That's right.
There's more of a, John, and I love you, but there's more of a chance of you winning the Miss Universe pageant tomorrow than someone being able to take delivery at Cushing tomorrow. It's impossible.
Right.
So with that being said, it's not like something where you could take, even if, let's say, corn or grains, again, if you had to dump the corn, you dump corn. It's not so hard to do. Back in the 90s, I remember a trader who worked with me and myself. We were in the sugar pit at an off market, and Joe Terranova was with us. And in a non-prime month, the spot price of sugar, which was trading at the time like 8 cents, which would be 8.00, right, went to one tick, 0.0001, the minimum amount. And I remember us buying it in the last half hour then, because I knew there wasn't an environmental problem, and I knew I could actually take delivery. Even if I have to give away the sugar, I remember saying to Joe and John, I said, listen, if worse comes to worse, we have to dump the sugar, we'll dump the sugar. The bag has to be worth more than the one tick, right? But this is not the case in oil. You have something that environmentally, you have to take delivery. There's huge penalties if you don't, huge penalties. And there's no way to get rid of and there was no way to get rid of, environmentally the oil. So nobody could take delivery.
It's crazy. It's absolutely crazy, Mark. Let me ask you, I know you only have another minute or so, so let me ask you another question. Do you ever watch that volatility index for crude oil? I mean, you live it, so you probably don't need to, but I use that OVX as a way to kind of see the craziness that's in your market. And just for instance, folks, it went from 120 or whatever it was at prior to last Tuesday, Monday and Tuesday and Wednesday's craziness. It went all the way to some crazy numbers like 500%, Mark. Literally numbers we'd never seen before. So this will show you, by the way, folks, I'm putting it up on the screen. I'm going to screen share it. There it is, the crude oil volatility index. It's back down, Mark, to 173. But on the 21st and 22nd, it was up around 500% because nobody'd ever priced in negative crude before, apparently.
Correct.
Just hadn't happened. All right. As far as a look forward, Mark, do you have anything looking forward? I know you've already said about natural gas. Do you have any look on?
Well, looking forward in crude, people are going to be scared to eat long crude now. So counterintuitively, when people are scared to be long, it probably can, you could basically buy the dips until for a while at least. And then the last 4 days before June expiration, which will be in the middle of May, will be the moment of truth for June. Now, I saw some encouraging things that Saudi Arabia is trying to cut back now and not wait until May 1st on barrels, which may or may not help everything in terms of that. But again, I think the moment of truth is going to come in the last 4 or 5 days of June. And the interesting thing is, if you look out, John, June crude's trading $15, $16. July crude's trading $21. September crude is trading $25. December crude is trading $33. So the marketplace, is telling you that this is a short-term problem. Whether it is or not is yet to be seen. But if I were you, John, I would concentrate myself on where we are on the board out in December than where we are in June, which is going to be, a much more violent move one way or the other.
Mark, I know you got to go. You've been very generous with your time. Thank you very much. Really, truly appreciate it. These are stories you won't get from anywhere else, folks, other than somebody who lives trading these futures contracts. And he has dozens and dozens still of traders that are doing that. Isn't that right, Mark?
Well, I wouldn't call it dozens, but we have a handful of dozens. Let's put it that way.
Handful of dozens. And these are guys that do this every day for a living, folks. Just kind of heed his advice as far as trading that into the final days of the contract. If you're somebody that thinks you're going to be smart and trade that into May, thinking that you're Mark Fisher, you might want to think again. Anyway, Mark, thank you very much for your time, sir. Good luck. Have a great week, and we look forward to talking with you again soon.
Stay safe.
Thank you, Mark. You too.
Bye.
Beautiful. Nicely done, Mark.